So how can we make use of an automated trading system? This is the next question. What is an automated trading system? Well, basically, it's a computer program that automatically submits trades to your broker or to an exchange. So in this particular instance, if you're with LMAX or ATC or whoever your broker is, the actual program will take the trade and not you. Sometimes these automated trading systems are referred to as black box trading systems. All automated trading systems are based on systematic trading structures and generally have defined strategy parameters. Sometimes you can change these parameters, sometimes you can't. It depends on the particular system that you have and depends upon what the program allows you to do. The idea is that the computer program has an algorithm that will actually execute pre-programmed trading instructions. So there will be a certain amount of variables in that. Sometimes it will be to do with time, other times it will be price. There could also be variables with regard to quantity of the order, and what I mean by that is how big your lot size is likely to be. So we're going to give you something called Firefly, which is just something that we've developed over a period of time. Now what Firefly is it looks to establish a breakout of a specific range. Now earlier we talked about the idea that this is, in addition to being an automated system, is actually a teaching aid as well. And the idea is that you start to look at the way the trades or look at the ranges that the system is producing, and you start to see why that the EA is taking these particular positions, and it will teach you about how the range is formed or a current price range can be calibrated. The actual system itself is calculated to work on 15 or 1 hour time frames. Now this is quite important. If you try to run it on a time frame below 15 minutes, you're going to have problems. It is not designed to run on time frames below 15 minutes. It's only designed to run on 15 or 1 hour time frames. The reason for this is, as I just said earlier, is that if you try to run if you try to run an EA on a shorter time frame, you tend to get problems with regard to volatility. So it's something that's important to look for when you're looking at these sort of things. Volatility isn't really kind to automated trading systems necessarily, unless they're designed to take advantage of volatility. Generally speaking, consistent price action is better for automated systems. Now this particular system that we're going to let you have a look at is really designed to trade euro dollar. Now we have got backtests which make it positive on pound dollar, dollar yen and Aussie dollar. You're free to put it on any chart you want, but realistically in the short term I would put it just on euro dollar on an hour and a 15-minute, just not to confuse you. As I said, the point of this is more as much a teaching aid as anything else. It's actually programmed currently for MetaTrader 4, which is hence why I told you all to download the LMAX MT4 program. What I will do is I shall also run it on another demo account so that you can correlate between the two to see what trades have actually been taken. Now, the EA itself should theoretically run all the time. So an EA, by the way, means expert advisor. It's just a term that the MetaTrader company used for their automatic programs that you create. Now the EA itself, as I said, should run over the whole trading week. Theoretically, you should use something called a VPS, but I'm not saying you should all go and get VPSs. A VPS is a virtual private server, i.e. it's basically a computer in a cloud whereby you, if you can imagine a virtual desktop, a virtual Windows computer in the cloud where you just stick a MT4 program and run it and it runs all the time. But if you don't mind leaving your computer on all the time, that's fine. If not, just leave it on when you can. You'll see the trades come through anyway, but obviously you're going to have the clearest indication, and it would only work really effectively if you're trying to watch it as a means of actually trading or making money from it. If you ran it all the time, it wouldn't work otherwise. But in terms of teaching aid, it's fine if you just run it when you want to run it locally. But as I said, if you can leave your computer on, you'll learn a lot more by letting it run all the time if possible. So what are the criteria for entering? It's like, as with any automated system or any systematic system, we need to establish a set of criteria. Now in this particular program, what we've done is, as I said, it's based upon something called a range breakout. Now what you will find is that in the Forex market tends to be generally in two states, either trading within a range or trending. And when it moves from one to the other, it's often referred to as breaking out. Breakout points can be considerably profitable or extremely profitable. Sometimes the range itself will be respected, but once that range is broken, reasonable profits can be made by catching that breakout, so to speak. So this is purely set up on the basis that we're looking to see where the breakout points on the range might be. However, we do set a couple of conditions. One of them is we use something called the Commodities channel indicator. Now you might ask me what that is. That basically is an oscillator. Now, does everybody know what an oscillator is? Anybody who doesn't know what an oscillator is? Okay, well, if you can imagine that oscillator means it moves between 2 points. So you have 0 and 100 often on oscillators, not actually on the CCI as it happens, but on a lot of oscillators which you'll come across like stochastics or relative strength index. These are two others that you're going to come across that operate in a similar way. You will have a system whereby you have 0 and 100, and you'll find that if price is trading over 80, it's often overbought, they consider, and if it's under 20, it's often oversold. So price will move between these 2 points, oscillate between the 2 points. Now the actual grid for a CCI is different, but don't worry about that. But fundamentally, it is an oscillator, so it's moving between 2 points. And in this particular EA, we have a setting whereby if you're going to go long, it has to be above this setting, i.e. the market has to be in a bullish mode. Or if it's going to go short, i.e. you're selling, it has to be under a certain point, i.e. it has to be in a bearish mode. And this just helps filter out bad trades. That's the objective of that. A commodities channel indicator, you could use either theoretically we could have used an RSI, we could have used a stochastic oscillator, but a lot of people actually find the commodities channel indicator CCI to be the best, and I would agree with them. How the EA works is that it sets pending orders for the breakout. So the reason we've done it this way is that you can actually see the orders and start looking at where on the chart you might actually find the range. So hopefully what you will do is you will start taking notes of the pending orders, and when you see the pending order itself, you will then try and draw a line on your chart, so you then start to begin to establish ranges, and you can see how the EA itself has established a particular range, and you'll start to be able to pick ranges more easily gradually yourself for manual trading, and that's the objective here. Use the pending orders. What they do is they're reviewed after every candle. So if initially you just stick it on, say, a 15-minute chart, initially, I mean, my advice to everybody would be take the euro dollar as your pair and just put it initially just on a 15-minute chart, because it will give you the most number of trades and candles. If you then every candle close, or on the opening of every new candle, the trade will refresh just to make sure that the same criteria have been met and the actual price or the range still has remained the same. So that's something to bear in mind. Okay, so it will refresh. So you get, what you'll find is in your account history, you'll find lots of what one would call cancel trades, and what that is basically the refreshing of the trade on each candle. It's re-evaluating each candle whether or not criteria are actually being met. So what are the entry, the exit criteria, excuse the slide. The exit criteria is basically we use a trailing stop. So the idea is we're trying to find as much profit as we can out of the particular system that we're using. What we use is initially we have a fixed stop, so obviously you can only lose a certain amount, and in this particular case we use a multiple of ATR. Now you'll ask me what ATR is. ATR is something called average true range, and really it's just it's a bit like a moving average of the day's price. So for example, if you have a high of or you have a pip range of 100, let's say, in a day's trading range, so i.e. let's say pound dollar move between 163 and 164 in the course of one day's trading, what you do is you take that and then you calculate an average of every single day what the range was, or if it was a 15-minute, what every 15-minute candle was, and you'd work out what the price range was for each candle, and that would be your average true range. And what that does is it means that because it's based on a multiple of average true range, it's giving you a fixed or giving you a it gives you a fixed stop in relation to each trade, but each trade will have a slightly different stop because the average true range is going to vary after each candle. And the other thing point for this is that when you vary it with different instruments, such as say if you used Aussie dollar or if you used dollar yen as also for this EA, you'd find that their stops were different because the average true range on those pairs are different. Something to bear in mind is that each currency pair behaves differently. Yes, I will do Shola later. I should probably do a special video which I'll send out to you guys for that as well, so you can look at it on how to actually install it on your MT4, so you know exactly the procedure to install and how to actually operate it. I'll probably do it via video, and then I'll send you a link to it during the course of the next couple of days. That's probably the best way to do that. Then you can keep referring back to it. So as I said, one of the important things to remember is that each currency pair behaves differently, and something you have to come to terms with when you're actually trading. You might have a set of strategy for dealing with euro dollar, but say for example you wanted to trade pound yen. You will find that pound yen actually behaves in a slightly different fashion to euro dollar, and this is something that you've got to understand. So using exactly the same criteria isn't necessarily going to work. So you'll have a situation, if you try to apply criteria with which you've been successful with on euro dollar to pound yen, you might find it doesn't work as well with pound yen. Hence why with any automated trading system or with any robot, you will find that they're really designed for specific currency pairs. And in this case, it really was designed just to use euro dollar. Why euro dollar? Because it has the lowest spread, so it's the cheapest possible pair to trade. It just happens to work on other pairs in backtest, but generally speaking, euro dollars it's been designed for that. So if you went and put it on, say, I don't know, CAD yen, Canadian dollar yen, you might find it doesn't work at all, purely because that pair is going to behave in a completely different way to the way that euro dollar behaves in. So that's just something to bear in mind. Okay, so we establish a fixed stop, and then we trail from this fixed stop, and we calculate the trail by using two other indicators, something called a Keltner channel and a Bollinger Band. And what we're trying to do is we're using a calculation based upon the two. We're multiplying what is something called a Bollinger Band range. Now, what are Keltner channels, Bollinger Bands, and Bollinger Bands range, you're going to ask me? Well, a Keltner channel is all of these, both of these systems are actually named after people. But Keltner created this idea that he used a single central line and worked out a simple moving average, whereby he took the day's price at the high and the low and the close, divided it by 3, and created a simple moving average line with that calculation, and then created an envelope either side of it, i.e. a set distance either side of the of that line. So if you can imagine, you have this central line and two lines that run parallel to it. Some people trade these. Not a lot of people trade Keltner channels, but a lot of people will trade Bollinger Bands. And Bollinger Bands works on exactly, or very similar principle. Again, it has a central moving average, but the actual envelope, or the bands either side of it, are dictated by volatility. So the Keltner bands are actually tend to be a fixed distance apart, and they're calculated by the high and low again and close of the price, whereby the Bollinger Bands will vary much more dramatically and are based on volatility. And the actual Bollinger Band range is the actual calculation of the volatility. So what we do is we measure the difference between the upper band and the lower band. Again, when we look at Monday week, I will show you in more detail some of these indicators so you get a better idea of them. But just quickly, for your benefit, the actual upper and lower bands, you'll measure the difference between the two, and what you'll find is that they widen and narrow. And so therefore, when you use the Bollinger Band range and you multiply that with the Keltner channel, you will get a variation. And so as the volatility narrows, the trailing stop will pull up, and so will reduce your liability. That's the principle behind it. Again, a lot of this might be over your head for the time being, but once you start to see it in action, it'll start to make a lot more sense. So it's really a question of actually putting it and running it, and then throwing questions at me Monday week on the issue. And there's one other way of exiting the trade, and that is whereby how would I best describe it? Yeah, we have a fixed point at which we will exit the trade. So if the trading stop hasn't been triggered after a certain period of time, then there's an overriding trade length parameter which will just close the trade. So if after 9-10 candles the trade is still running, it'll just close. And that's just because after running multiple back tests, it's proved to be the most, how can one put this? Yes, it's a question of it provides the most continuity with regard to profit. So it's not a question of necessarily maximizing the profit. As I said before, we're not in the business necessarily to maximize the profit, and the reason we don't maximize the profit is because if you try to maximize profit, you end up with a situation whereby you have what they call curve fitting, i.e. you keep looking at past prices and you keep trying to make what your system fit those past prices. Now, I think wherever you see trading or whatever, you will often see a phrase, past performance doesn't dictate future performance, and that's because markets change. And when markets change, price action changes. So if you try to fit everything to exactly how previous price action is concerned, you're more than likely going to fail. What we've got to try and do is fit everything to be the most consistent So if you look for consistency rather than necessarily overriding profitability, the chances are that your system, whether it be a manual system or an automated system, is likely to stand the test of time and the rigors of time, and that's very, very important to understand. So consistency is far more important than optimizing profit, because ultimately you might be very, very profitable in the short term, but you might in the long term find that you're not profitable because the market conditions have changed. Sorry, Dave, what do you say? What about consistent profit? Well, yeah, I mean, it's got to be consistently profitable. There's no point in having consistent losses. That's easy to achieve, but consistent profitability rather than optimizing maximum profitability, that's what we're looking for, David. So we're looking for constant returns over a longer period. So in many respects, this, a automated trading system is a bit like a position trading system, or even like holding a share. You'll often find that the better ones are, if you were actually theoretically using this as a means of actually making money, you would find that it's one of those things you have to use over a long period of time, because it's going to have periods where it's going to make money, it's going to have periods where it's not going to make money, and that's just part and parcel of the system. There is no whatever, when you continue your Forex career and you look around and you research, you'll see lots of people advertising different systems, unbelievable profits you'll see. Ultimately, all of these things are likely to fail if they're optimized for the very, very short term. There is no silver bullet with regard to trading, and certainly there's no silver bullet with regard to automated trading. Yes, you can make money, you can make reasonably good money, but you have to accept that there's a way and a means of doing it. No system is always going to win. It just doesn't work that way. Everything has certain losses, and it's a question of minimizing your losses is how you actually end up with the most profit at the end of the day. If you remember what I said on Monday, the key to being a successful trader is to minimize your losses. Often your profits will end up taking care of themselves. Being a good loser is everything. So this particular risk reward is programmed in such a way whereby you can actually dictate your own risk reward criteria. By default, it trades just what you call one mini lot. So you can leave it on this to start with if you want. You can also change the settings to use money management. So what I mean by that is there are settings in there so you can risk, each trade would risk, let's say, as a maximum 1% or 0.5% or 2% of your account for each trade. That's up to you. Some traders like to risk 2% all the time. They're often aggressive traders. If you come to room and find Sam, he's an aggressive trader. He likes often to risk 2% of his account on each every time he takes a trade. That's his way. I'm a lot more conservative. If I risked 0.5%, I'd be pushing it. I'm a much more conservative type trader. Everybody is different. That's another thing that you're going to come across. Each one of you in this room, all 10 of you, are going to sit there and you're all going to have a different mindset. I'm sure there are going to be some aggressive traders and I'm sure there's going to be some conservative traders. All can do well. You all get to your goals, but it's just finding the path that suits you best, ultimately. So let's have a look at how these have tested, how this is tested. Now, you're going to have to probably increase your window size to see this, but if you have a look at this is a back test. Now, what is a back test? A back test looks at all the previous history of trading, and in this particular instance, in my draw on it here, we have looked at the last, well, we looked at from 2011 through to 2014, and if you had run this, you would have achieved, where are we, around 25% gross profit over or total net profit over a period of that time. it actually gives you the total gross and total loss. So your net profit is this bit here, if I can find it. So this is what you would have eventually got. So your profit factor for each trade is 1.21. Now for me, the most important piece of information on this chart is this, other than the fact it's made a profit. There are the two most important things for me are these things. Right? Has it made a profit? And over this period of time it has made a profit. Okay, I need to change that to a better color, I think. But what is more important, what is the drawdown? Okay, and that is the most important. So the maximum drawdown over this period was 4%, or just around 4%, which is good. And the idea of this is that when it does lose, it doesn't lose much. Now, ironically, and this is a good example, and this is another good reason why this is a good method of teaching, is that if you actually look at its percentage success rate, it's actually below 50. Okay, so it's got a 45% success rate and a 43 and a total success rate of 43.58. So only 4.3 trades out of 10 are going to end successfully. So why is it profitable? And this is a very important part as well, is that it's profitable because if I find the right, I've just changed it. Should be on here somewhere. Average profit is greater than average loss. Does everybody see that? Does everybody understand that? That average profit is greater than average loss, and therefore the risk reward is right with regard to the system. So the system doesn't have to win all the time, does it? As I said, it only wins 4.3 out of 10, or 4.3.5 out of 10 times. But because your profit is greater than your loss, ultimately you will win. And the best way to look at this is in a chart. Now this plots every single trade over the course from 2011 through to 2014. And as you will see, so for example, we talk about periods of time when it's reasonably stagnant. Do you remember we talked about shares a minute ago, and how, I mean, this will possibly look a little bit how a share, a graph on a share might look, so to speak. So there's periods where it has down periods, but not very much, and then has long periods whereby it's very profitable, and sometimes it's to do with the time of the year. So, for example, this area here was between about May and June, sorry, between about April and August this year, where we had very, very little price action. And this little uptake here was the fact that in September we had a hell of a lot of price action, and things looked very good. Now, these two charts are based entirely on one mini lot. So this is just the basic least, you've got to put it at one micro lot. So this is one mini lot. Now you could have changed the settings and run it as a percentage of your account for each trade. Now by doing that, you're upping the risk. That's the first thing. You're upping your possible risk, but you're also upping your possible rewards. Okay, so this is exactly the same system, but using, I just find out what this was tested for. It used 2%. So we can see at the top here, in this particular case, it sets money management true rather than false, and therefore ignores the lot size, but looks instead for risk in percent, which is there, and that's 2%. So each trade would have risked 2%. But what you will notice is a dramatic increase in profit, but also a big increase in possible drawdown, which is 15.89. Now that's still actually well within an acceptable risk with regard to a lot of traders. I mean, each is going to be different. I don't know how much you would, when you have a share, how much you'd expect to or allow it to reduce before you got out of a share. But for many, that would be reasonably acceptable. Again, the actual percentages in these particular cases is exactly the same. Okay, so nothing has changed there. But the average loss and the average profit have obviously changed. So this time the average profit from each trade is 133 and the average loss is 85, and that's where the difference has widened. And this is why you've now in the period got a situation whereby you've actually made 110% over the course of the 3.5 years that this is run on the back test. So that's what you are. The average number of losses, that was something else I'm going to show you on, is 2. Sorry, and the average number of wins is 2 as well. So, or consecutive wins and losses. So you're never going to go on a huge number of runs of losses, which is also important, often from a psychological point of view. Okay. Okay, and this is the chart. By the way, this particular chart doesn't necessarily risk exactly 2%. It always sets a maximum of 0.5 as the maximum lot it will take. If I took this off, you'd probably find this profit was a lot bigger, because